As we continue our discussion on the quality of financial statements, we continue with the cases we were discussing. We've already seen a couple of cases around the booking of early sales, booking sales early, as well as a case around a high amount of goodwill that a company has not written off, right? So eventually that could mean that these are some sort of red flags that are there in terms of looking at a company. And how would you interpret what's the quality of financial statements? Let's look at a few more. Now, the first one we will take is something about capitalization of expenses. Right now, where does this term come from? When we say capitalization of expenses, it's typically treating expenses as assets. Remember, in buying an asset and in spending money, in both the cases there is an outflow. So whenever there is an outflow from the company, it's either an expense, right, or you are buying an asset, right? Now some companies might choose to capitalize the expenses, which is essentially treating your expense as an asset, right? So expense is being treated as an asset. Take an example. Let's say you borrow 1000 crore for a factory, and you build a factory whose cost of building is 1000 crore. Now, because you've borrowed 1000 crore to build a factory, there is an interest on this factory on this loan of about 100 crore. Now, should the cost of the factory, should it be 1000 crore or should it be 1100 crore, right? Because this interest has been taken only in order to build the factory, on the loan in order to build the factory. If there wasn't a capital investment in the first place, this interest would not have been there. So in these kind of cases, it makes sense to take the cost as 1100, in which case, while interest is a cost or an expense, right, we add it up to the overall amount, which is 1100, and then this 1100 gets depreciated, right? So 1100 is equals to 1000 plus 100. This 100 is also getting depreciated. It is not getting expensed in that year. So when you capitalize the expense, the question is whether you are expensed it, which is in 1 year, or depreciating it, which is over multiple years, right? So many years. Now, in real life, this is allowed. You can depreciate it over many years. And in the case of the example that we saw around capital investment, it is not unfair as well. It's fair enough, right? But the question is, what expenses do you capitalize? The question sticks to what expenses do you capitalize? In that context, it might be interesting to see that some companies choose to capitalize other areas as well, right? Now, so we saw that interest is capitalized, that's fair. It is also fair to capitalize R&D expenses, right? Why? Research and development, is kind of capital expenditure. It takes many years. It takes many years for R&D to kind of justify the investment that has happened into it. So if you are a pharma company that does a lot of research and development, you can capitalize this, because this is in a sense fixed asset creation, right? If you're able to kind of discover a drug in due course of time, that could be a big asset to the firm. Some companies, however, may try to use this yardstick to other expenses as well, and we'll see what the problem is with that. So take the example of this company called Groupon, which is a discount website. It's also available in India, but Groupon is preliminary a US website. When they were doing their IPO a few years ago, in their IPO listing, they came up with some statements, right? The statement said that they are reporting something called as adjusted consolidated segment operating income, or some sort of adjusted income, and the measure excludes expenses that the company considers non-cash or otherwise not indicative of future operating expenses, right? Now, the measure removes online marketing expense, acquisition related cost, and stock-based compensation expense, right? Now, what they have done is they are saying that the marketing expense that they are doing, which is basically advertising expense, etc., they are essentially capitalizing this. And what's their argument? Their argument is that the customer, it's basically cost to acquire new customers, and so the customer might stick to the company for many years. So the customer might give revenue to the company for many years. Marketing expenses are being capitalized because it's cost to acquire customers. And if you think about it, assets give you revenue over many years. The company claims that customers will give revenue over many years. Right? Now there's nothing that is out of the ordinary here. The problem, however, is that you're not sure whether the marketing expense really resulted in the company gaining those customers or acquiring those customers, as well as you don't know if the customer will actually stick over these years. In the case of the asset, you know that the building will last 10 years. In the case of a customer, you're not sure if the customer will stick to you for 10 years. So if the company had a loss of operations of 117 million, right, and that reflected about 180 million of marketing expenses, if you remove it, it suddenly makes a positive adjusted income. Now the company shows positive profits because they have knocked off the marketing expenses. Now that doesn't make sense. Marketing expense has to be an expense that has to be written off in that year. You don't find companies really taking marketing expenses year on year, saying that this is like brand building exercise and we are going to kind of make money on these expenses over multiple years, right? That's what Groupon did. That's wrong. That's not really the best way of representing earnings. So you have to be careful about companies that are capitalizing expenses. Capitalization of expenses in the context of India primarily comes under capitalizing interest, right? So effectively, if your total interest cost is, let's say, 4,000 crore, you may choose to say that out of these 4,000, 2,000 is capitalized. And where will you find this if this 2,000 is capitalized? You will find in the item called capital WIP, work in progress. You will find that this goes there. So the P&L statement will only show 2,000, right? That effectively, if you capitalize interest, it under reports the interest, right? It under reports the interest, and that's a problem when you look at a ratio like interest coverage ratio, right? Because you are looking at the interest that is on the P&L. So in this case, if you calculate the interest coverage ratio, you will use EBIT by 2000, whereas in reality you should be using EBIT by 4000, right? So whenever companies capitalize expenses, this results in higher profit, and that has to be gauged through carefully. So if you find any evidence that the company is capitalizing expenses, you do need to read a little bit more on these, right? So that's about capitalization of expenses. We'll look at one of these examples in a moment. So to understand this, let's take the example of a company like Hindalco, and we look at the annual report of Hindalco, and we look at 2015 annual report. If you look at the numbers, the P&L, consolidated P&L statement for the year, and you look at the numbers, you see finance cost here. Look at the year 2014. The finance cost is 2701, right? So if you were to calculate the ratio on interest coverage, you'll see 2701, and you'll calculate it on this. Let's look at this note number 33. And this once again outlines the importance of using something like the annual report and noting what's happening with the company. If you look at this note 33, that outlines what's happening with finance cost. Let's see. So we go ahead and we go to note number 33, which is finance cost. 2014, the number we saw was 2701, whereas in reality, interest expenses, other borrowing cost, and loss on foreign currency translation combined together were 4,800, 119, 36. That adds up to something like 5,000 crores, right? Then they say transfer to capital work in progress. This is what is getting capitalized, and that's 2,300 odd crore. So the interest cost, which was actually 5,000, is now appearing to be 2,700 on the P&L. In reality, the cash outflow would be 5,000 crore. The company would have paid 5,000 crore that year. They have just accounted for 2,700 crore. So it's allowed. It's not wrong as such, but just that if you are evaluating this kind of a company, it is important when you look at the interest coverage ratio that there is some sort of a capitalization of expenses that is happening that reports higher profitability, and you have to be careful about this higher profitability that comes out, right? That's about capitalization of expenses. Let's look at another example. Let's look at this company, where if you look at these 3 years, you do find that the sales went up and they kind of stagnated, went down a little bit. Operating profit margins have gone up, so it seems that profitability has improved. You will also see that net profit has kind of gone up from 107 odd crore to 200 crore. That's almost doubled, right? So profitability seems to have improved dramatically for this company, right? Is that the complete picture, right? Now, there is a possibility that the company is showing profits, but that may not mean that the company is actually receiving or generating cash. How do we know whether the company is generating cash or not? We just need to look at the cash flow statements and look at the cash from operating activities. That's negative 500 crore, negative another 500 crore, and there is a huge negative jump in the final year, right? Now, if you think about it, cash from operating activity is coming from net profit plus depreciation, correct? Which is a non-cash expense, so it gets added. So net profit should add something. This 200 crore should add the depreciation amount which is here, minus change in net working capital. Remember, increase in receivables is a problem. So it is fairly possible that in this particular company, we have a scenario where receivables are jumping up. We don't know it as yet, but it's quite possible that receivables or inventory, one of these two, are piling up big time, and that's causing the cash going down. Now that's not good. If you think about it, what's happening beyond that? They increased capacity in the first 2 years, and they borrowed money as well in the first 2 years. So borrowed here, right? But in the third year, there was possibly a repayment that came. People stopped lending them money. So what do they have to resort? They are negative here. This is a positive number. So they are selling assets now in order to stay afloat, right? So while profitability seems to be improving, this looks like a great idea. The point is the company does not seem to be collecting cash, and that's causing a big problem for the firm, right? That's another example that when you look at profitability of a company, whenever you're looking at profits of a company that needs to get translated into cash, a company can keep reporting profits, but a good company, you will find that over a period of time, your profit number should be similar to cash from operations number, at least similar over a period of time. Now, 1 year it is possible that profit goes up, but receivables will also go up. But if it is a good company, they will collect it over a period of time. So let's say over a 5-year period, over 5 years, you should see that the cash generation is similar to your profitability growth.
at least the growth number should be similar. So if your profits are growing at 20%, your cash from operating activities should also be growing here. Here the profits are doubling, but the cash is becoming double negative, right? So it's halving if in that context. So that is a very, very important premise that we learn, that whenever you look at companies in this context, it is important for us to figure out what is the company up to in terms of generating cash for the business. Remember, cash is a fact eventually, and all businesses, while they work for generating profits, those profits are meaningless unless you receive cash in lieu of those profits, right? Finally, there are sometimes companies who use the money that they have to showcase an expense, right, as an investment. And now some of these are expenses which are actually bad expenses, not really good, right? So you see, the company purchases an aircraft for rupees 270 crores because the company, and they, what's the reason? They say that top management will travel using this and they will save on their time using this. Now the company is actually struggling, profits are going down, and the company management claims that this is an investment, right? Now if you want to kind of understand what do you think will happen to the stock market around this, the company stocks plunged almost 44% in a month. In a month from July 19th, the day the company reported disappointing results, and after a wider section of investors took notice of the jet purchase. You can have bad earnings, but if you are wasting money, this is a wasteful expenditure, and that's what investors don't like. You don't want to see companies doing this, and that's why a lot of institutional investors like mutual funds and foreign institutional investors, they have basically forced Crompton to sell the jet again, right? And they've sold it to another group entity, and their idea was that it has been made clear to us that the company will get the entire money back. So they have sold it back for 270 crores after this hue and cry that came up. There are ample evidences of companies making decisions, and then based on shareholder work or the reaction that the share markets give them, companies roll back these scenarios. Very recently, there is a bank called DCB, Development Credit Bank, which said we will double the number of branches in 2 years. Now the stock market didn't like it because the bank was in trouble. The bank wasn't really doing as well, right? And if you're not doing as well in the banking segment, there is no point in becoming ultra aggressive in increasing the branch network. So the stock fell significantly, and the next day after the stock fell, the company rolled back the plan. Right now, that's how the stock market basically reacts to any kind of wasteful expenditure or any kind of data that they think is not going to be good for the company in the long run. It's important for companies and managements to understand this, and it is important for us as analysts to be able to review all these activities that the companies resort to, right? So let's quickly outline what are the key red flags that come to our mind, right? If we see a ratio of cash earned versus sales, right? How do you know cash earned versus sales? Technically, if your sales are 1000 and your receivables last year were 800 and this year are 1500, then what is the cash that you have earned? 1000 plus 1500, 1000, and you have not earned 700 out of it, so minus 1500 minus 800, so that gives you 300 is what you have earned. Receivables have gone up by 700, that 700 must have come from this 1000, so what you have collected is only 300. So you can try and find out what is the ratio of cash earned versus sales. Cash earned is nothing but sales minus change in receivables. Now a lot of textbooks will not give you this definition. This is the definition that we have created here.
as we had started in the beginning of ratio analysis and said that any ratio is fine as long as it gives you a meaningful number. So this is a meaningful number. You can find cash earned by sales and you can divide this by sales. That's the ratio, right? Now, practically you do this analysis and you realize most good companies over a period will have this number close to 100, or in 1 year less than 100, next year more than 100 kind of a number. The second one is operating cash flows and profits. We just saw that example, right? At least the growth should match. If your profits are growing at 20%, operating cash flow should grow at around 20%. If profits are growing at 50%, but operating cash flow is growing at 10%, there is a problem, right? There's an immediate problem. The third red flag is goodwill being a large proportion of total assets. We saw an example of Subex, right? There are other examples as well where goodwill is a big proportion of total assets. Tata Steel is an example, and as we speak around this, Tata Steel is planning to sell their UK unit around these data points that are coming up. Huge goodwill. They overpaid for the acquisition. It's not turning around. Unsecured loans, a big portion of loans. Once again, when you look at the long-term borrowing in the balance sheet and you look at the notes to account around that will give you a description of where is the long-term borrowing coming from. Is it secured or unsecured? If you find a big unsecured portion, there is a problem. Low interest cost. Remember, in the case of Hindalco, we saw 2700 as the loan, right? Now, how do we know whether this is low interest cost? Let's go back and let's quickly look at what is their total borrowing, right? If we look at the total borrowing of Hindalco, that borrowing is about 53,000 crore of long-term borrowing and 9,000 crore of short-term borrowing. So approximately close to about 63,000 of borrowing, right? Now, if you think about it, for a loan of 62,000 crore, in India, you should have an interest rate of at least 8 to 9%. That should result in approximately a loan interest amount of close to about 4,800 to 5,500 crore. That's the actual amount, but they're reporting only 2,700. That should raise an eyebrow. So you should look at the total loan amount and find interest by loans. And if this number is less than 5%, then there must be some capitalization that is happening. So you have to be careful, right? Your interest divided by the loans amount. Some of these are advanced concepts, and as you keep working on more and more companies, these will evolve. But the idea is that if we kind of pay attention to some of these questions, we may not have answers to these questions, but it is important for us to raise these questions. So note what I'm saying here. It is not important for us to have the answers to these questions. It is important for us to raise the correct questions, right? As analysts, we are supposed to question, right? And as long as we can question, we will be able to find the answer. But we do need to question these things when we talk about companies, when we are looking at analysis of companies. If at the end of the day, the analysis of a company is done and you're able to question the numbers and you're able to kind of ask those relevant questions to the company or the management or to yourself when you're doing this analysis, that's 90% of the job done. If you can ask the right questions, you will get the right answers, right? That's it in terms of the cases. That's it in this particular